and welcome back to another Money Tip Monday. For those of you who are new to this awesome channel, my name is Lizy Hoeffer and I am a residential mortgage loan officer here bringing you practical money tips to help you make smart home purchases. Today on Money Tip, I wanted to talk about how mortgage insurance can make a bigger impact on your monthly payment than your interest rate. But before I get into that, I am gonna need you to like, comment, and subscribe to this awesome channel. And if you feel so inclined, I would love for you to share it with a friend. To start off this video, I think it's really important to just explain why I think mortgage insurance is such an important thing to talk about when you're shopping for a home loan. And it's because as a loan officer, I get calls, emails, text messages all the time that are, I'm so concerned about my monthly payment. I'm very concerned about my budget. I don't want to pay over X amount. I need the lowest interest rate because. And what I find is a lot of consumers aren't educated on the impacts of mortgage insurance and how they can do a couple of little things, whether it's changing the program, it's, paying money to actually buy out their mortgage insurance, putting more money down to lower their mortgage insurance, that can actually have a bigger impact on the monthly payment versus just getting the lowest interest rate. Now, this is like this weird disclaimer that I hope doesn't make me sound like too pushy on why you should use somebody like me. But when you call in to call centers, typically people will just call in and ask for what they know, right? So they'll say, I need a 30-year fixed mortgage at your lowest interest rate possible. And whoever answers the phone will just give them a 30-year rate mortgage with the lowest rate that's available with buying points. So buying points is typically, which is discount points, is typically associated with getting a low interest rate. But it's very, very rare that you're gonna call into a call center and they're gonna go, you know what? Let's actually go through a couple different mortgage scenarios with you, whether it's conventional versus FHA versus 3% versus 5%, and it's rare that you'll get a total loan analysis that compares a variety of different mortgage products, right? So that's why it's so important to actually talk to somebody who has experience in mortgages, who has done it for a long time and isn't just going to present to you the thing that you called in about. At my team, it's required to do 3 to 4 different loan scenarios, whether that's a combination of buying mortgage insurance out, it's buying the interest rate down, it's switching between a conventional and a government product. I want people to have options, right? Because if you don't have options, how do you know you're really getting the right mortgage product? And just because you're getting the lowest interest rate, sometimes that actually costs you more money in the long run because you could have done something else. So I just want to give you some brief examples of the differences between credit scores using the same loan amount, right? Using minimal down of 3% and versus a 3.5 with FHA, and just so that you can see the differences in the monthly payment on a mortgage insurance comparison. Now, just to give you a good point of reference, the difference between let's say 4.5% interest rate and a 5% interest rate on a $200,000 mortgage, the difference between that payment is about $60. And that's just a rough estimate, not a mortgage quote, but I just want to give you a point of reference because, right, the difference in a mortgage insurance scenario can vary between, like, if let's say you had a 680 credit score, that mortgage insurance would be $200 a month versus $116 a month if you had a 740 credit score. Right, so there is a huge difference. This one's almost $100 difference in mortgage insurance increase depending on credit score versus just the interest rate, right? So I can just show you just right off the bat that mortgage insurance will have a bigger impact to your monthly payment than your interest rate. Now, so a couple things that you should know. Credit score, debt to income ratio, and loan to value are going to be the biggest things that have an impact on mortgage insurance. And then there's other factors like the number of borrowers. So typically the more borrowers on a loan, the less likely it's to be foreclosed upon. And then you have things like occupancy, right? So are you going to be living in the home, right? Are you using down payment assistance program, right? Is this going to be a second home or an investment, right? So the loan type of program, right, will also impact the type of mortgage insurance, right? So you want to pay attention to all of those things. And when you're getting mortgage insurance comparisons, you want to make sure that you're doing it on a variety of different products. So 3% and 5%. And then you should also look at things like what's my monthly payment versus what is my upfront cost if I were to buy it out altogether, and then there's a hybrid of what you could pay to buy down a percentage of it and then have a lower monthly, right? So just to give you a comparison, if on a $200,000 loan, if you had a 680 credit score, a monthly premium would be around $200. To buy it out completely is about 3.68%, which is $7,360. And then to do a split edge where you're buying it down, right, is about $2,000, and it saves you, it goes down to $168 a month, right? So I mean, it's a pretty big swing, right? You would have to, one, understand how long you're going to be in the property, right, to really understand if this makes sense for you or not. Okay, now this is the same loan scenario if you had a 740 credit score. Okay, that monthly mortgage insurance drops down to $116. The buyout is actually $4,300, so 2.19%. And then if you were to buy it out at 0.5%, right, you would actually take it down to $103. Now I'm gonna say, just from looking at these last two scenarios, I don't know that it makes sense to do the hybrid, but if you have excess seller contributions, right, on your transaction and your lender says that you can't buy down the rate, ask them if you can buy out mortgage insurance. Now, the last thing I want to do is compare this type of thing to an FHA loan, because FHA loans get really bad raps when it comes to mortgage insurance, because if you do their minimum down program, the mortgage insurance stays with the loan for the life of it. So as long as you have it, you will pay mortgage insurance. It also includes an upfront premium, right, that's financed into the home loan, so you do lose a little bit of equity. But the benefit to an FHA loan is because it has so much insurance and it's backed by the government, the interest rates on these loans are typically 1/4 to 0.5% lower than you would get on a conventional loan, right? So we're talking about maybe a $60 savings there. And if you have a credit score that's around 680, right, it's way cheaper to go with an FHA loan than it would be to go with a conventional loan. Okay, so those are things that you really, really need to consider. Same scenario on a $200,000 mortgage, that mortgage insurance premium is $141.66, right? That makes a whole lot more sense than getting a conventional loan. It's so important that you educate yourself on all of these differences. But just to sum this up, you can pay it on a monthly basis, you can buy it out up front, you can do a hybrid where you're, paying a certain percentage and bringing down the monthly payment, and then you should always compare it to whatever your government program is. A lot of down payment assistance programs will have subsidized mortgage insurance, so even though the interest rate is higher on those programs, the mortgage insurance is a lot less. Definitely compare those. And you should always go with a reputable mortgage lender who will compare lots of different scenarios for you, because that's the only way you're gonna know if you make a smart purchase. Now guys, I am gonna be breaking this down in a lot more detail on the blog, and I'm gonna be doing maybe a live Q&A. So I'd love to get your questions, love to hear feedback, love to read comments on your particular mortgage scenarios, and then running it through our SMART process so that you understand how to evaluate a loan comparison. So would love to hear your thoughts, would love for you to join us live. So don't forget to tune in and follow us on our other social media platforms, Instagram, obviously YouTube and Facebook, and get on our mail list, okay? So tune in to another Money Tip Monday next week. I look forward to hearing from you guys.